If you think the next big Forex move comes from a chart pattern, you are watching the wrong screen. In 2026, the real driver is central bank policy divergence, and a shaky stock market is pouring fuel on the fire. Let us break this down for the USD, the EUR, and the JPY. Right now, the Federal Reserve is holding rates higher than the market wants. The European Central Bank is openly leaning toward more cuts to protect the slowing Eurozone, and the Bank of Japan is finally inching policy in the opposite direction after years of ultra-loose settings. That gap between three of the most important central banks on the planet is exactly what currency traders call divergence, and it is the cleanest fuel for trends on EURUSD and USD JPY. Now layer on the stock market. Every time the S&P 500 takes a sharp leg lower, global investors do the same thing they have done for decades. They sell risk and rush into the world reserve currency. That is the safe haven bid for the US dollar, and it shows up almost instantly in a stronger dollar index and weaker EURUSD. The yen normally plays the same defensive role, but with the Bank of Japan slowly tightening while the Fed slowly eases, USD JPY can behave in unusual ways during a crash week. So how do you trade this without getting chopped to pieces? First, watch the calendar. Fed minutes, ECB press conferences, and BOJ statements are the moments where divergence either deepens or unwinds. Second, watch equity volatility. When the VIX spikes hard, you want to respect the dollar strength, not fight it. Third, size down. High divergence periods produce wider stop losses, so smaller position sizing on your Exness account is how serious traders survive long enough to win. A simple framework is this. If stocks are falling and US data stays firm, lean with the dollar against the euro. If stocks are falling and the BOJ is signaling more tightening, be very careful shorting the yen. If stocks recover and risk appetite returns, watch for EURUSD to bounce as the safe haven trade unwinds. The point is not to predict every tick. The point is to align your trades with the biggest macro force in the room, which in 2026 is policy divergence colliding with equity stress. Stay patient, respect your stops, and let the macro do the heavy lifting. If this breakdown helped you see the bigger picture, drop a comment with the pair you are watching this week, and I will cover it in the next video.